Good afternoon, ladies and gentlemen. Let me introduce myself. My name is Teresia Trisanti. I'm the lecturer of STAYKPN, Yogyakarta. Today, I will present my research with the topic Determining Company Factor on the Impact of Financial Distress, an empirical study of property and real estate Indonesian company. Introduction. The development of modern economic happening in Indonesia right now is increasing significantly. This development has led to demands for companies to develop an innovation and expand to be able to compete with other companies. Companies that are unable to compete will experience bankruptcy. Before bankruptcy occurs, companies will experience financial distress or financial difficulties. Platt in 1995, research revealed that financial distress is the initial state or condition for the first time a decline in the company in finance before bankruptcy occur or liquidation occur. Financial distress will be very useful information for the company because financial distress can be used as an early warning before bankruptcy occur, so that company will easily anticipate bankruptcy by improving the company performance. Bankruptcy itself in Indonesia is regulated in Law Number 1 of 1998 concerning about bankruptcy, the content of which mentions debtors who have two or more creditors and cannot repay at least two debts which is due and cannot be billed are declared bankruptcy by an authorized court decision, both at their own request and at the request of 5 people or more creditors. Platt and Platt argue that financial distress information has several benefits. First, management will be able to quickly take precaution before bankruptcy. Second, management can do a merger or takeover in an effort to repay corporate debt and to manage their company better. Third, financial distress information can be an early warning before bankruptcy occurs in the company in the future. According to Kisei, profit margin, leverage, liquidity are the most dominant ratio to determine the company financial distress. Another study shown at company growth ratio also can be used to determine company financial distress. Another internal factor company can affect the financial distress is the size of the company. The size of company illustrates how big the total asset owned by the company to manage their operation process. The study combined two studies above by using the ratio of profitability, liquidity, leverage, and sales growth to detect whether the company is experiencing financial crisis or not. The property, real estate, and building construction sector for this research because this sector are one of the investment alternatives that investors are interested. Investment in this sector are long-term investment, and these companies are multi-purpose assets that can be used by the company as collateral. Therefore, the company has a high capital structure. However, property, real estate, and building construction sector are very vulnerable sectors in the macro industry against the fluctuation in the interest rate, inflation, and exchange rate, which will ultimately affect the purchasing community to buy the property, real estate, and so on. On the background described above, the researcher identified the problem as follows. How does the profitability affect the financial distress? What is the effect of liquidity on financial distress? Leverage also in financial distress? Sales growth and financial distress? How does size can mediate the relationship of profitability, liquidity, leverage, and sales growth to financial distress on property, real estate company? Literature review. Signaling theory used in this research because signaling theory can use to explain that financial statements are used to give positive signal, good news, and negative signal, bad news to the capital market and public. Eklafani and Lung conducted research show that financial statement information can be used as a media to find out the signal of the company failure. Some researchers opinion that the signaling theory is related to explain the relationship determining in financial distress of the company. The benefit of financial distress information for the several parties, according to the Gopalan and C, as follows. For the lender, benefit for the lender or creditor are in the decision-making effort which company will be given loan and to monitor the loan that have been given. Investor, the information for investor is that investor will easily see the sign of the company in bankrupt, so this is used by investor to sell their share and bond quickly as possible. For the government, bankruptcy will quickly government can take necessary initial action before running in the business. For accounting, financial distress information will be useful in assessing the sustainability of the company in business. Several studies that use Altman Z-score model reference bankruptcy detection for a company, such as research conducted by Lyon and Lowers. This study used Altman Z-score in detected financial distress because, according to John et al., the Altman Z-score model has the higher level of accuracy in detecting financial distress in company. The Altman Z-score model classification company health into the three classifications, namely safe zone or company that have a low bankruptcy risk, gray area or middle condition, and a distress or potential strong bankruptcy. The Altman Z-score method is used for financial distress detection, expressed in 5T, which is represent the financial ratio. According to Yudiawati, the development of Altman Z-score model as follows. X1 is explanation about the capital, working capital, total asset. Working capital is obtained by the mean of current asset plus current liabilities. X2 is return earning to the total asset. Return earning are the number of profit are not distributed for the shareholder. X3, profit before interest and tax on total asset. Profit before interest and tax, also called earning before interest and tax, is used for the X3. X4, book value of equity to total debt. The book value of equity obtained for the amount total company equity to total debt. X5 is sales of total asset to asset of the company. The current asset used by the sales for the company. And then the result of criteria Z-score are if the Z value is bigger than 2.99, the company can be said to be healthy or has the potential small bankruptcy in a good financial condition. B, if the value bigger than 1.81 or less than 2.99, the company in gray area or midway between healthy and distressed. C, if the Z value less than 1.81, the company is predicted is going to bankrupt or distress. The research hypothesis as follows. For the first hypothesis, profitability has a negative effect on financial distress. Hypothesis 2, liquidity has negative effect on financial distress. Hypothesis 3, leverage has positive effect on financial distress. It means that the higher, the bigger company have a debt, company have a positive effect on financial distress. Hypothesis 4, sales growth has negative effect on financial distress. If sales growth increase, the financial distress is get lesser. This is the research framework figure 1. Profitability H1, liquidity H2, leverage H3, sales growth hypothesis 4, the effect of financial distress as dependent variable. For the intervening variable, in this research, company size choosing as intervening variable or mediating variable. Why? Because some research concluded that large companies are able to establish will easier to find to obtain the capital in the market compared to the small company. Large companies are already established, have a strong position, can easily get more fund money if they need it. It means that flexibility large company is greater compared to small company. Therefore, it is hoped by size company can mediate the variable for dependent and independent variable. The hypothesis as follows. Company size mediating the relationship between profitability and financial distress. Company size also mediating relationship between liquidity and financial distress. Company size mediating relationship between leverage and financial distress. Hypothesis 8, company size mediating the relationship between sales growth and financial distress. Figure 2 show the research framework for intervening variable. Company size choosing as intervening variable between profitability and financial distress, and so on. 1. Explain about the sample criteria. For the 4 year, there is 164 companies using for observation. Table 2, list of R-square. R-square, earning management practice, is 0.671. It means that the model can explain the variable affect the financial distress is 67.1%. Other variable 33% can explain by other variable. This research use smart PLS algorithm, and then the model display as follow. This is the independent variable. 4 independent variable: return on asset, current ratio, debt to equity, growth, and mediating variable size of the company. And this is financial distress applied by Z-score. Table 3 show the hypothesis result. From profitability affect the financial distress represented by Z-score have effect with p-value less than 5%. It means that if company profitability get 1 of the same, and then financial distress get lesser. Liquidity also have effect on financial distress. It means that if company have a high liquidity, financial distress will get lesser. And then leverage, this is the leverage, also have effect. Growth sales didn't have effect on financial distress. Size have effect on financial distress. 4. Explain the specific indirect hypothesis result effect. We can show from hypothesis 6, profitability has effect on financial distress with company size as intervening variable. The p-value is less than 5%. Liquidity also has effect on financial distress with company size as intervening variable. Leverage has effect on financial distress with company size as intervening variable. Growth sales didn't have effect on the financial distress with company size as intervening variable. Then conclusion and limitation. From the result of the research discussion above, the following conclusion as follow. Profitability, liquidity, and company size affect financial distress, but the growth didn't have effect on financial distress. And size can be as variable mediating relationship, profitability, liquidity, company to financial distress. And then this study has some limitation as follow. The research used only property real estate, so the research can be generalized to other type companies. Researchers have not examined other variables such as activity ratio, cash flow, and management tenure, and so on. Suggestion for future research as follows. First, for investors need to pay attention whether the company is in condition financial distress or not before deciding to invest their money. Second, for company, the management need to consider the factor that influence the condition of financial distress so that company can avoid the bankruptcy to take a good step to maintain the company. Number 3, for future researcher, future study have to add another variable that may be affect the financial distress and can use another method to determining financial distress such as the camel, spring gate, and so on. Other variable can add as management structure, audit committee, and activity ratio. That's my presentation. Thank you for your kind attention, and if you have any question, please don't hesitate to ask me. Thank you.